So in respect of this question, it's mainly to do with the issue of joint ventures, but we've got to go through it bit by bit, date by date, and make sure that we answer everything. So the first thing that we come across is in section A. And it's in relation to the oil field. So the oil field is an enterprise jointly controlled by Burley and Slight. The fact that Burley has a 60% interest does not make the oil field a subsidiary, because it is not a company. Burley should show 60% of the oil field as an asset per IFRS 11, because that's the proportion of the oil field to which we have an entitlement. In respect of the oil extracted, we're told that 200,000 barrels were produced up to the 1st of October, but none were produced after this date. So Burley is entitled, and if we're looking at this, to 60% of the 200,000 barrels taken to the 1st of October 20x9. The oil was sold to third parties at $100 per barrel. So therefore, Burley's share is 200,000 times 60% times $100, and that equals, let me just do the maths, So Burley's share would be 12 million. So just concentrate on the numbers that you can see. You will be able to produce some numbers. These questions are never easy. It also says that Burley has extracted 10,000 barrels more than its quota. And it says in the question that there's a net cash settlement of any over or under extraction by one company. So because Burley has over extracted, by 10,000 barrels, it owes slight 10,000 times $100. It owes slight $1 million. So what we should do is we should debit purchases 1 million and credit slight as a payable 1 million. But it says the net cash settlement would be at the market price of oil at the date of settlement. At the 30th of November 20x9, the market price is $105 a barrel, so Burley has to increase the amount due to slight. It's $5 a barrel times 10,000 barrels, so it's $50,000. This is because the best estimate of the sum due to slight is using the oil price at the SFP date. So all the time I'm trying to pick up individual elements from the question. I'm reading the question, trying to formulate. Now it then says that the price of oil falls. The decrease in the oil price to $95 a barrel is a non-adjusting event after the SFP date. This is because oil prices are traditionally volatile, and so the decrease does not give extra evidence about the year-end price. When Burley pays Slight, what's it going to be? We're going to credit cash. It's going to be 10,000 barrels at $95 a barrel. So we're going to pay 950,000. When we make that payment, we have cleaned the debt out. We no longer owe any money to Slight. So I'm going to debit the Slight payable. $1,050. And I'm going to credit the income statement in the year ending the 30th of November, Y0, with the gain of 100. Pardon? Derivative? No. Remember, a derivative is an instrument where the initial cost is far lower than the amount finally settled. Well, this isn't, is it? The amount we settle to Slight, well, there's no initial... Well, but the value of the contract... No, it's not, because there is an initial cost, because initially I go debit purchases, credit Slight payable. And what's happened to the Slight payable is that it's only gone up by 50,000 and it goes down by 100,000. It wouldn't constitute a derivative because it's a trading contract. Remember, a derivative is normally a contract where there is no product being transferred. It's merely a forward contract to buy gold, but you never actually physically take delivery. So that's the first item. It also says Burley had purchased oil from another supplier. Now again, in the exam, the vast majority of the students completely ignored this. Don't know why. So if we then look at the oil from the other supplier, inventories should be measured at the lower of cost and NRV. The cost is $98 a barrel. The NRV at the 30th of November X9, well, the expected selling price is $105 a barrel, but you then subtract your selling costs, which are $2 a barrel, so that's $103 a barrel. Therefore, the inventory value, it's 5,000 barrels at $98 each. Now that's F7, isn't it? That's something which every student who's ever studied accountancy would have learned in the first year of their learning. And yet in the exam, 2/3 of students decided that they weren't going to attempt it because it was another paragraph at the end of a section. RTFQ. Read the full question. because there was 2 marks there, and I don't think we can afford to throw away 2 marks. Secondly, we have Jorge. So we entered into an agreement with Jorge. Each of the company holds 1/2 of the equity in another company called Wells. Wells is a joint venture with Jorge because, firstly, each party has an equal shareholding. Secondly, control is shared. Between Burley and Jorge. Thirdly, Burley is not responsible for Wells's debts if Wells becomes bankrupt. And we can sell our shares and we're entitled to a share of profits. So these are the main criteria. So per IFRS 11, Burley should account for Wells using the equity method It will therefore take 50% of net profits to its income statement and 50% of Wells's net assets to the Burley statement of financial position. So I've explained what the equity method is. Under IFRS 11, the only method we can now use for joint ventures is the equity method. You used to be able to use something called proportional consolidation. That option has been abolished under IFRS 11 to bring IFRS into line with US GAAP. We've then got the oil wells themselves. And it says that they started operating on the 1st of December 20W8. So we've got to look very, very carefully here at our dates. So at the 1st of December W8, sorry, the 1st of December X8, the start of the current year, the value of the oil wells was cost, and we're told the cost is 240. less depreciation, 10/40ths, because it's a 40-year life of 240, so our depreciation is 60, which takes us down to 180. However, added to this is the present value of the decommissioning costs. Sorry, included in this, I should say. Now, I felt the question was a little bit... It says the initial cost of the rigs was 200, which included decommissioning costs. So, included in this is the present value of the decommissioning costs. We're then told the decommissioning costs have fallen in value at the 1st of December 20x8 from 32.6 million to 18.5 million. So what I'm going to do is I'm going to credit PPE, the value of the oil wells, with the difference of 14.1 million, and I'm going to debit the income statement with an impairment of 14.1 million. Therefore, the oil well is now valued at 180 less 14.1. It's 165.9 million. This is depreciated over the remaining useful life of 30 years. So that's going to be 165.9 divided by 30 equals 5.5 million a year. The decommissioning provision is increased by 7% in the year. Which is the new discount rate. And IFRS specifically says if the risks change in relation to something of this nature, you need to reflect the new rate of risk. Therefore, we're going to debit income statement 7%. What was the value of the provision? At the start of the year, the provision was valued at 18.5. So that's going to be debit income statement 1.3 and credit provision 1.3. So that deals with the oil rigs. Then we come to the pipeline. So what I'm trying to do in terms of structure of my answer is I'm telling the marker this is where this bit ends and this is where the next bit starts. So I underline each separate element of my answer. We've got a 10% interest in the pipeline, which is used to transport oil from the offshore oil rig to the refinery. We've got joint control over the pipeline. So this is a jointly controlled asset. Per IFRS 11. Because Burley shares it with other oil companies. Burley will therefore show its share of the income, costs, assets, and liabilities. The pipeline is PPE rather than an investment. So, can you just go back to that previous sentence? Can you show its own income, costs, assets, and liabilities in relation to the pipeline? Wasn't worded very well. You see, all the time I'm trying to get each sentence down, separate bullet point, 2 lines, piece of information included in it. And if they say we want to treat it as an investment, we've got to say whether that treatment is appropriate or not. And here it's inappropriate. We then move to part C. And here we're looking at the license. And it says Burley wishes to capitalise the cost of the license, but is unsure whether it can do so. Well, the license is a potential intangible asset it will satisfy the definition of an asset if, firstly, Burley has control of the license. This appears to be the case. As Burley has paid for it. Secondly, the license will generate economic benefits. This will be the case if the license allows Burley to successfully drill oil. Now this is we don't know at this stage. If this does not succeed, an impairment should take place, or an impairment would be required. Because one of the reasons why we have an impairment is if an asset generates poor performance. So if we've bought the license because we believed there were 1 million barrels of oil to extract, and we subsequently find there's only 300,000, that would indicate that the license is generating poor performance compared to our expectations. Thirdly, it's due to a past event. That's fine, we've satisfied that. And fourthly, the cost is measurable. Well, this will be the cost paid. Burley, by Burley. Burley should therefore create an intangible asset at cost because it has satisfied the recognition criteria. Now, Burley also has to determine whether the extraction is commercially viable, so that's fine, that's part of our overall establishment. And we're probably about to go as far as that. But you might want to say past experience has shown us that the license can increase substantially in value. What I'd perhaps say as a final sentence, Burley can only revalue the license upwards if there is an active market for such licenses. So I think I've probably written enough in that section for 4 marks. Yeah, I've got quite a few points there. Then there's 2 marks which are given for professional marks for clarity and expression. Well, clarity means clearness. So ask yourself, have the points you've written, are they clear? Have you expressed yourself using appropriate language? So is it reasonably professional? And what the marker will be doing is that as he or she goes through your script and is marking it, he'll be saying, well, yes, this is clear, and yes, this does appear to be at the correct level of what I would expect from a professional person.